Welcome back to Stock Market Insights. Today we're leveling up your trading vocabulary with advanced stock market terms every trader needs to master before diving deeper into the markets. Clearly understanding these terms will give you confidence and help you navigate more sophisticated trading scenarios. Let's begin. The PE ratio helps investors gauge if a stock is fairly priced. It's calculated by dividing the stock's current price by its earnings per share, or EPS. High PE ratios might mean investors expect future growth. Low PE ratios could signal undervaluation or declining performance. For example, Apple trades at $150 per share and has earnings per share of $5. This makes the PE ratio equal to 30. If the industry average is around 25, Apple's stock may be considered slightly expensive. EPS indicates how profitable a company is per share, calculated as net profit divided by total outstanding shares. Investors use EPS to compare profitability among companies of different sizes easily. Example: Google earns a net profit of $20 billion and has 2 billion shares outstanding. Its EPS equals $10. The higher the EPS, the more profitable a company typically is. Dividend yield shows the percentage return you receive from dividends relative to the stock's price. This helps investors seeking regular income decide where to invest. If a Tanditi pays $2.50 annually per share, and its stock price is $25, the dividend yield equals 10%. That's $2.50 divided by $25 multiplied by 100%. Beta measures a stock's sensitivity compared to overall market fluctuations. A beta of exactly 1 means the stock moves in line with the market. A beta of 2 suggests the stock is twice as volatile as the market. A beta of 0.5 implies half the volatility. High beta stocks often attract short-term traders. Moving averages are popular technical indicators that smooth price data over a specific time period, allowing traders to identify trends clearly. Common examples are the 50-day and 200-day moving averages. If a stock price moves above its 50-day moving average, traders might interpret this as bullish momentum. Resistance is the price ceiling where selling pressure prevents further rise. Support is the floor where buying pressure stops a price decline. Traders use these price points to identify potential entry and exit levels. Short interest represents the percentage of a stock's shares currently shorted by investors betting against it. High short interest might indicate bearish market sentiment or potential for a short squeeze, leading to a rapid price increase if short sellers rush to cover. Market sentiment describes investor emotions and attitudes, whether bullish, meaning optimistic, or bearish, meaning pessimistic. Sentiment can dramatically influence prices, irrespective of company fundamentals, especially in the short term. The bid is the price buyers are willing to pay, while the ask is the price sellers demand. A narrower bid-ask spread indicates high liquidity, making trading easier and less costly. On the other hand, a wide spread suggests lower liquidity and potentially higher transaction costs. Float is the number of shares publicly available for trading, excluding locked shares held by insiders or institutions. Stocks with low float often experience extreme volatility due to limited supply. RO measures how effectively management uses shareholders' equity to generate profits. A consistently high ROE indicates efficient management and profitable reinvestment. If Company X generates a net income of $5 million with $25 million equity, its ROE equals 20%. Investors prefer stable, high ROE companies. A liquidity trap occurs when investors prefer holding cash rather than investing due to economic uncertainty or fear, reducing overall market activity. This scenario can slow down economic recovery significantly, as investors refuse to deploy capital. Leverage involves borrowing money to enhance potential returns. It can significantly amplify profits, but also losses. A 4-to-1 leverage means your $1,000 allows control of $4,000 in trading positions. It requires caution due to increased risk. When trading on borrowed funds or margin, a sharp price drop can trigger a margin call. This is a broker's demand to deposit additional funds or sell securities to cover losses. Traders must understand margin risk clearly to prevent sudden losses. Options are financial instruments giving investors the right, not the obligation, to buy, which are call options or sell, known as put options, a stock at a predetermined price within a specific time frame. They can provide protection or speculation opportunities but require advanced understanding due to their complexity and risk. The yield curve plots the interest rates of bonds with similar credit ratings but different maturity dates. Typically, short-term bonds pay lower yields while long-term bonds offer higher yields due to increased risk over time. A normal yield curve slopes upwards, meaning long-term investments earn higher interest. However, an inverted yield curve, when short-term interest rates exceed long-term rates, often signals investor concern about future economic conditions. Historically, such inversions have accurately predicted economic recessions. Traders closely monitor the yield curve to anticipate changes in economic cycles and adjust their strategies accordingly. Index funds and exchange-traded funds, or ETFs, offer investors an easy and cost-effective way to invest in the broader market. An index fund typically mirrors the performance of an index, such as the S&P 500, meaning it automatically holds shares of every company in that index. This approach reduces risk by spreading investments across many companies. ETFs function similarly but trade like individual stocks on exchanges. This means they offer flexibility for buying and selling throughout the trading day. ETFs and index funds have become popular because they generally have lower fees than actively managed funds, making them ideal for investors seeking passive, long-term growth or simple portfolio diversification. Growth stocks are shares in companies expected to grow faster than average due to innovative products, expansion, or reinvestment in business operations. These companies rarely pay dividends as they prioritize reinvesting profits to fuel future growth. Investors in growth stocks are typically willing to pay premium prices, hoping future earnings will justify their investment. In contrast, value stocks represent companies trading below their intrinsic or true worth, often due to temporary setbacks, market conditions, or investor sentiment. These stocks typically have lower price-to-earnings ratios and frequently pay regular dividends, attracting investors looking for steady income and lower risk opportunities. Understanding the difference between growth and value investing helps traders and investors align their portfolios with their risk tolerance, financial goals, and investment philosophy. Excellent job. You've significantly expanded your market vocabulary and are now prepared for advanced concepts ahead. Mastering these terms provides clarity, confidence, and the ability to communicate effectively within the trading community. If you found value in this video, make sure you like, subscribe, and share. Your support helps us keep creating great content for you. Stay tuned. Our next videos will put these terms into practical examples, reinforcing your learning journey. This video is for educational and informational purposes only, and should not be considered financial advice. Trading and investing involve significant risks, including potential loss of principal. Always consult a qualified financial advisor before making investment decisions.